Inventory valuation is often asked as part of other topics, including manufacturing, tangible assets, and VAT, as is done here. The following information was taken from the accounting records of Craig's Computers for the year ended 31st of August 2022. The business buys and sells laptops and highly durable laptop bags. It's always a good idea to make a note of what you're actually doing so that you don't get confused about your product. Before we look at all the information, let's go and see what's actually required. Firstly, we need to calculate the cost of each bag on the 31st of August 2022. Then we need to calculate the correct total asset value of the laptop and bag that were taken from stock for use by Patrick, an employee. Now, obviously, if it's a laptop and bag, I would immediately go and make a little note that I want to track the cost of the laptop and I want to track the cost of the bag. In number one, we're calculating the cost of each bag, so that answer would be part of my calculation of the bag cost. If they were taken from stock, that means it's coming out of inventory and turning into an asset of the business. In other words, it's going to be the business's computer equipment or something like that. We don't know exactly what they would classify it as, but that's what's happened. It's changing from inventory that will be sold to an asset that will actually be used by the business. Calculate the total depreciation on vehicles for the year ended. So obviously we would do our depreciation calculation. It's sometimes useful to remember that we would want to show any sold if there was, any old and any new, because those are all the kinds of depreciation that we might possibly have. Calculate the carrying value of the vehicle taken over by Craig on the 1st of March. Obviously, carrying value is your cost less your accumulated depreciation. Although, of course, it is possible that there might be other ways of calculating it. If, for example, we know that there was a profit or loss and we know what the carrying value is, then we could look at the difference. Complete the tangible assets note to the financial statements. And you can see here that we do have vehicles, as we've seen, and computer equipment. As always, go and do T accounts for those. There's a little bit of space at the bottom of the page, so I would just do it over here. And I would show a T account for my vehicles, as well as the accumulated depreciation on vehicles. And then I would show my computer equipment and my accumulated depreciation on computer equipment. Once you've done your tangible assets note, you're then asked some questions here. Give both reasons the bookkeeper was wrong about the treatment of VAT on delivery of the laptop bags to the business. So we're obviously going to need to go and find more information, but we're looking at VAT on delivery of the laptop bags, and we're going to have to see why they were wrong. Why should the bookkeeper not have claimed back VAT on the laptop taken from stock for Patrick? Now, obviously, you can go and see if there's any more other information, but you might even figure it out right now. If you're taking a laptop from stock, in other words, it was in the inventory that was going to be sold, and suddenly now you're taking it as an asset for the business, you would already have claimed back the inventory, the VAT in the beginning, when the inventory was bought. And you certainly can't claim it back twice now when you're just taking it from inventory. Why should VAT be accounted for on the vehicle taken by Craig? Also, you can come back to this later if you wanted to, but as soon as you realize that anything is going out of the business and the business is VAT registered, you need to charge VAT. And the reason that this would be necessary is because it can be assumed that VAT would have been claimed when it was bought. Calculate the amount owing to SARS for VAT for the period of July and August. So obviously this is just working out what is the output, what is the input. If you wanted to, you could do a little SARS VAT account. Remember, this is a liability account, so it would look like that. You obviously don't have to do it as a T account, but I always like to do T accounts so that I can easily see what's going on. Now we can start using the information. The laptops are carefully controlled to ensure that the oldest inventory is sold first, to ensure that the technology does not become outdated. And so FIFO is used to value the inventory of laptops. Bags, however, are sold at random, and the weighted average inventory valuation method is used for bags. Now, what I would do over here is immediately go to where I need to calculate the bags and make a note to remind myself that my bags are at weighted average. In other words, I'm going to look for the value divided by the quantity. We can then see that we've got some inventory records. We've got information about the laptops and we've got information about the bags. Now, the laptops, we aren't asked anywhere to calculate the value of laptops at a certain date like we are for the bags. However, we are asked to calculate for the laptop that was taken over. And we can see over here that we've got a laptop for Patrick was taken and a bag was taken. Now that can be used over here, the information to find out if that laptop was taken on the 31st of August, can you see that it would have been taken out of the closing stock? So the closing inventory would obviously have been after the laptop, but all the last stuff that is in the business would have come from the last purchase because it's using FIFO. So it would have come out of those 10 that were purchased at the end. In other words, the value of the laptop bag would have been 11,000. So over here, you can put it for number 2, the 11,000, which is the FIFO cost. For the bags, we can use the information that's over here to do weighted average calculations. Obviously, we would want to use the total value at the beginning and the total value of everything that was bought. And we'd want to use the quantity at the beginning and the quantity of everything that was bought. So we would say 19,500 plus 36,000 divided by 25 plus 45. I'm not going to calculate anything yet because there's still more information and we don't know what else needs to go in there. Tiago, the bookkeeper, had calculated the VAT control balance on the 31st of August as 52,400. Owing to SARS. In other words, it would be a credit balance. So immediately we can go to our little calculation of VAT and we can show that there would have been a balance on the credit side of 52,400. An invoice for 575 Rand, VAT inclusive, was received from Mambwere Movers for the delivery of the laptop bags on the 31st of July. Now, delivery needs to be treated as part of the cost. Because remember, cost of sales is the cost of getting the goods to the location and the condition needed to be able to sell them. So we can split this up into what is the VAT and what is the cost. Obviously, to work out the cost, we can say 575 times. And if you need to, this is where you can quickly draw your little VAT triangle. VAT is 15. It's 15% of the exclusive amount, which would then be 100, and inclusive is therefore 115. The 575 is what we've got, which is inclusive 115, and we're looking for the cost, which would be the exclusive 100. The VAT amount would be calculated in exactly the same way, 575 times, but this time you're looking for the 15 over the 115. And using those calculations, you'll then be able to get the figures that you'll need for the cost of the delivery, which we would need to add into our VAT, the cost of the delivery, which we'd need to add into the cost of the laptops or the laptop bags. And so we'd show that over here as plus the 500, because remember that the delivery is part of your cost of sale. So it's part of the value that you would need to use over there. The VAT amount we would need to go and show in the VAT account. And you would show that obviously if you have paid the 575, you can claim back the 75, which would have been the delivery on the bags. You can then see that they've told you that Tiago, the bookkeeper, did not include the VAT in the VAT control account because he considered this to be a service that was not subject to VAT. And in addition, the bags were still unsold. So because he didn't include it, that's why we've now added it to the VAT. But we can also use this to go and answer the question that says, why was Tiago wrong about the way that he treated the VAT on the delivery of these bags? You can see that there are two things here. The first thing is he said, oh, it's a service, and so it's not subject to VAT. Keep in mind that VAT is levied on goods and services. And so the fact that it's just a service doesn't mean you can exclude it. Then he says the bags were still unsold. In reality, it doesn't matter. The VAT can be claimed as soon as you've got the invoice. You don't even have had to pay for it yet. Number 5, Patrick has been employed to start work on the 1st of September and was given a laptop out of stock to use in his daily activities on the 31st of August. This is the one that we already saw earlier, and we worked out that obviously it's going to go out of the inventory, but then it's going to go into the computer equipment. So now we have a little bit more information about the fact that he was given it on the 31st of August. That's when the transaction happened. So it means that my computer equipment account is going to have an increase of the new computer that was taken out of stock. We don't yet know the total value because the total value we are going to calculate over here. We know that once we've got the total bag amount, we can add it in. We can then see that Chabalala Tex was paid 1,500 Rand to set up the laptop with the software and data. They are not VAT registered. So thank goodness we don't need to worry about VAT for that one. But the fact that they had to set it up, remember that the cost of an asset includes all the costs to get the asset again to the location and condition where it can be used. If they hadn't installed the software and his data, he would not have been able to use the asset. And so therefore, the installation cost is also going to be part of it. So we'll use that as part of the calculation, and then all of that will obviously go to the computer equipment account when we know how much it is. Number 6, Tiago, the bookkeeper, incorrectly debited the VAT control account with 1650 for VAT on the laptop taken out of inventory for Patrick, and this must be corrected. We've already seen that obviously this is erroneous, and that it would not be needed because you've already claimed the VAT previously. But what it does mean is if they had already debited VAT to correct the error, you would need to credit the 1650. Number 7, Craig decided to take over one of the delivery vehicles on the 1st of March at carrying value. So that means that in your vehicles account, you would have something being sold on the credit side, even though it's just being sold to the owner. And it was on the 1st of March 2022. In other words, the business would only have had this for 6 months, from the 1st of September 21 to the 1st of March 2022. And so I always like to put my number of months over there, 6/12, because that's how we'll calculate the depreciation. The vehicle had originally cost 300,000 VAT exclusive, which means that's the amount I'm going to take out of the vehicles account. Because remember that your vehicles is always exclusive, and then SARS would obviously be the VAT amount, and the inclusive would have been the bank or creditors when you bought it initially. So that 300,000 can come out of vehicles like that, and had accumulated depreciation of 250,000 on the 1st of September. In other words, at the beginning of the current financial year. So obviously that would need to come out, the 250,000, but now put a little plus there so that you remember that when you put in your sold depreciation, then it's also going to have to come out again. So it goes in and then it comes straight back out. The depreciation policy is to depreciate vehicles by 20% per annum on the carrying value, and computer equipment 25% on cost. I would immediately make a note over here. Vehicles is 20% on carrying value, and equipment is 25% on the cost price. Now we've used all the information that we've been given over there, but keep in mind that there's also other information that has been provided. Over here, you can see that in the tangible assets note, we have been given some original information. We can use the original costs and accumulated depreciations in my T account. So vehicles was 725,000 at the beginning. That was the beginning balance. And there's 400,000 was the accumulated depreciation beginning balance. Now notice that I'm putting them right at the top, and I'm not putting them below the line, as I mentioned in the crash course. That's simply because we know for a fact that those are definitely the beginning balances. They're not the trial balance figures. If I'd been given trial balance at the end figures, I would have shown them below the line. I can then go and pull my computer equipment, had a debit balance of 75,000, and accumulated depreciation on computer equipment was 25,000. Now I have used all the information. We can go back to the beginning and start working through all the answers to see what we actually need to do. Right at the beginning over here, we can now calculate what is the actual cost of each bag. And if you work it out, you'll see that it ends up as 56,000 over 70 bags, which gives you an individual value of 800 Rand each. We can then put that over here as our calculation for number 2. And if we then add the 11,000 plus the 800 plus the 1,500, you'll see that you get a total value of 13,300. We can then take that value to the computer equipment. And so over here, we'll show 13,300 for the new asset that was taken. We forgot to put in the date when it was new, but that's okay. We can quickly go and fetch it. We can see that it was on, Craig decided to take it on the 1st of March. And so that also from the 1st of, that was the disposal one. The computer equipment is when Patrick took the laptop, and his is only on the 30th of August, when he was starting work on the 1st of September. So that is already at the very end of the year. So that's actually for 0 months out of 12. So you don't have to depreciate that. To calculate all the depreciation on vehicles, the easiest way to do this is using your vehicles account. If you look at the vehicles account, you can see that obviously the sold depreciation, we would need to use the 300,000, 20% on the carrying value. So we'd need to minus the 250,000 and then times it by 6/12 that you had it. So it's quite complicated. Let's quickly go and show that in the calculations. It would be the 300,000 minus the 250,000 accumulated depreciation. So that's the cost minus the ACDEP. And then you would say times 20% times 6/12. Nice little shortcut. If you see a combination of the 20% and 6/12, 6/12 is obviously a half, 20%, half of that is obviously 10%, which means it's much easier to quickly calculate that of the 50,000 carrying value, your depreciation is only 5,000. That we can then show in the accumulated depreciation that the sold item had 5,000, and obviously you put it in and you take it out. We can then work out on the old by looking at our T accounts again. There, I'm going to put them at the top so it's easier to see them. For the old items, we want to say what is left over in my vehicles. If there was something new, I would leave it out, but there isn't. We've only got these figures over here. So quickly go and work out in the margin, there's 424,000 is my cost of the old, and I circle it to get the O for old. So we know that the cost of the old is 425,000. I can then look for my ACDEP by saying how much is left in this account, and again, it's using everything. The nice thing is that the 5,000 comes in and goes out again. So you can actually just use the beginning balance minus the beginning balance of the ACDEP, and you'll see that there's 150,000 as the accumulated depreciation, which means the carrying value is 300,000 times 20%. You can see your carrying value over here is 275,000 times 20% equals 55,000 on the old vehicles. And you can then show that over here if you wanted to as old 55,000. And then the new, there weren't any new, so that's obviously 0. So your total depreciation is going to be 60,000 on your vehicles. The carrying value of the vehicle that was taken over by Craig, you would obviously have taken the original cost of the vehicle that was taken over, which we know already was the We already know from above that the cost was 300,000 minus the accumulated depreciation of 250,000, because obviously that was the sold item. But then you would also need to subtract the 5,000 that was calculated, and then you can see that the total carrying value was only 45,000. Those figures will then fit very nicely into your tangible assets note, but of course you can also work it out just by using the T accounts. If we're taking it straight from the calculations from number 3 and 4, you can see that the depreciation on vehicles is 60,000. Make sure that you show it in brackets. You could also have worked it out by looking at these two figures in accumulated depreciation. Your disposals you've worked out as the 45,000. You could also have used it by looking at your accumulated depreciation on vehicles, the combination of the 250 and the 5,000, as well as the sold 3,000, and all of those highlighted figures would have given you the 45,000 as well, if you didn't have to do it as a separate calculation. Let's now go and check that we've used everything. In the vehicles account, your new balance would be your 425,000 of the old, because there was no new. Your accumulated depreciation on vehicles, you can go and work out what the end balance is simply by taking the 400,000 plus 5,000 minus all the others. In other words, the original 150,000 that we worked out as the ACDEP on the old, and what the depreciation we calculated on that, and you would see that you would have a new balance of 205,000 at the end. These two balances at the end are actually the main reason why I always like to do the T accounts, because it's much easier to work them out in the T accounts and get them correct. If you're working it out in your head, it's very easy to forget about the items that were sold that make a difference to this. So we can show the 725,000 in vehicles at the top is already given. We've already used the asset disposal, so we don't need to worry about those. We can then use the 425 as the cost at the bottom. And then we know we've used all the vehicles figures. The accumulated depreciation, the 400,000 at the top is already entered. We've already done the disposal. We've shown all of that as the depreciation. And now we show the 205,000 as the ACDEP at the bottom. The computer equipment we'll need to also now work through. Obviously, we've got depreciation that we're going to need to calculate on the old, and this is nice and very simple because it's simply taking your 75,000 that was the balance over here and timesing it by the 25% that was given, and then you would add that to your accumulated depreciation. So the total depreciation will be 18,750. I'll show my calculation here. And then obviously that will give you a new computer equipment ACDEP of 43,750. And your computer equipment now has a nice new balance of 88,300. Notice the new, I didn't do depreciation because it was 0/12. We can now take all of those numbers. You can see obviously the beginning figures were already in. In fact, I got them from the tangible assets note to do the T accounts. We can show the new as additions at cost, 13,300. We can show the end cost, 88,300. And in the accumulated depreciation, I can show the 18,750 as the depreciation for the year. Again, make sure that it is in brackets. And then I can put the balance of 43750 at the bottom, again in brackets. And your tangible assets note is done. Hopefully you can see how much easier it is to do when you've got T accounts that you can see what's going on. We've then answered all the questions. And the last thing that we need to do is calculate the final amount owing to SARS. You can see we've obviously got our beginning balance of 52,400. We're going to add the 1650 and subtract the 75. What we do need to remember to do here is that the vehicle that was taken also needs to be added on. So over here, when Craig took that vehicle, we need to say the carrying value of 45,000 times 15 over 100 to get an amount of 6,750 as the VAT on Craig's vehicle that was taken. When you work that out, you will then see that there's an amount of 6,710 that is owing. Make sure that you indicate very clearly that this is the amount payable to SARS.